This video is about penny stocks, and if you're new, they probably look like the easiest way to start trading because they're cheap. Ironically, that same reason is exactly what traps beginners. Ow! By the end of this video, I'm going to show you what's actually pulling the strings behind penny stocks. This is the root of all penny stock evil, one small number that explains why they so often bite you. And for most beginners, it starts somewhere familiar. Maybe you first heard about penny stocks from an internet guru, or maybe a friend casually mentioned they made some serious cash from one. And now the thought creeps in, I'll just try a small trade, just to test the waters. I mean, what's the harm? Penny stocks don't look dangerous. They're tiny. And they bounce around like they're full of energy, right? And the math sounds irresistible. A 10-cent stock jumps to $1. That's a 900% gain. Compare that to big, well-known stocks with massive market caps. They move more like giant ships, slow to move and slow to turn. A $1 move barely registers. So I know why it's appealing. Penny stocks feel like speedboats, and when one suddenly takes off, it feels incredible. But here's the part most beginners don't realize. Those tiny boats capsize easily. And once you're in the water, you already know what's down there. That's what we're going to talk about. I want to walk you through the real risks of penny stocks, so that if you ever decide to trade them, you know exactly what you're diving into. No nasty surprises later. And by the end, you'll understand why most experienced traders never climb onto the speedboat. If you're looking for a straightforward, unbiased explanation of penny stocks without the noise, you're in the right place. All right, let's park the metaphors and start with the basics. What exactly is a penny stock? There isn't a single definition of a penny stock, but most people use the term for stocks that trade at very low prices, usually under $5 a share. Many trade for just a few cents, sometimes even less. At this point, you might be wondering where these stocks actually trade. You've probably heard of the big stock exchanges, places like the New York Stock Exchange and the Nasdaq. This is where most well-known companies are listed. Penny stocks, on the other hand, usually aren't. Most of them trade on over-the-counter markets instead. And at first, that might sound strange, maybe even unfair. You might wonder, why aren't they allowed on the main exchanges? Are these exchanges some kind of exclusive club? But there's a very practical reason for that. Major exchanges have strict rules. Think of them like pool rules. They're there to protect everyone. Companies listed there are required to regularly publish detailed financial information, like how much money they're making and how cash is actually moving through the business. Boring stuff for many people. But that information exists for one simple reason: transparency. Because if you don't have reliable financial information, you're not really investing or trading, you're guessing. And that's often the case with penny stocks. Some don't publish financials consistently. Others technically do, but the information is so thin or unclear, it's hard to tell what's really going on inside the company. And when real information is missing, that gap can be filled by hype and manipulation. Here's a real example. Let's rewind to 2014. Sync Technology claimed to be a tech company with a social media platform. On paper, it sounded legitimate, a company that was supposedly going to take off. Hype followed. Investors piled in, and the stock price exploded. For a brief moment, this essentially empty company was valued at $4.5 billion. Then the U.S. Securities and Exchange Commission stepped in and stopped the party by halting trading. The stock collapsed, and a lot of investors were left holding something that had looked exciting, but turned out to be worthless. And here's what came out when people dug a little deeper. Sync had almost no revenue, no real operations, and according to public filings, just one employee. Even your local car wash probably has more people working there. Later, the SEC charged an individual connected to Sync with fraud for using misleading filings and hidden ownership to prop up the stock. This is the kind of stock beginners need to approach with a lot of caution. At this point, you might be wondering how something like Sync could happen in the first place. Not why the price moved, prices always move, but why it was so easy for hype to push it so far, so fast. The answer comes down to one word: liquidity. Liquidity is simply how easy it is to buy or sell a stock at a fair price without pushing the price around. In highly liquid stocks, there are lots of buyers and sellers. Trades happen smoothly, and prices don't jump around just because someone places an order. In low liquidity stocks, things work very differently. When there aren't many buyers and sellers, even small trades can move the price a lot. That makes it much easier for hype, rumors, or bad actors to push prices up or smash them down. And this is where most beginners go wrong. They look at volume alone and assume a stock is liquid. But volume by itself doesn't tell you what you actually need to know. To really understand liquidity, you have to get one simple number. The one I mentioned earlier as the root of all penny stock evil. That number is called average daily dollar volume. It sounds technical, but the idea is very simple. It tells you how much money actually changes hands in a stock each day. Not how many shares trade, but how many dollars. And this matters because shares don't move prices, money does. To calculate it, you take the average number of shares traded per day and multiply by the average stock price. Most traders look at the average over the past 20 trading days. Price times volume. That's it. Once you see this number, a lot of penny stock behavior suddenly makes sense. Let me show you what I mean. Imagine two stocks. The first trades an average of 300,000 shares a day over the past 20 trading days. The second trades 1 million shares a day over the same period. If you stop there, the second stock looks far more liquid. This is where a lot of beginners get fooled. Now add the price. That first stock trades at around $200 a share, which means roughly $60 million is changing hands each day. The second trades at just 15 cents a share. Even with all that activity, only about $150,000 is actually moving each day. Once you look at the money instead of just the shares, the picture flips completely. The stock that looked busier is actually far less liquid. So what counts as good liquidity? What's a good ADDV number that helps keep your trading safe? There's no perfect cutoff, but many experienced traders prefer $20 million a day or more. That's my preference too. Once you drop below $10 million a day, things start to feel tight. And anything under $2 million a day is dangerous penny stock territory. This is where hidden risks tend to lurk. There's no hard rule. The right level depends on what you're comfortable trading. If you want to be cautious, starting around $20 million is a sensible place to begin. There's another simple check some traders use. They like to see a stock trading around 300,000 shares a day or more. It's not a hard rule. It just tends to go along with better liquidity and fewer nasty surprises. So you might be wondering why liquidity matters so much for your financial health. The first problem is the bid-ask spread. A bid is the highest price buyers are offering to pay. An ask is the lowest price sellers are willing to accept. The bid-ask spread is simply the gap between those two prices. In liquid stocks, that gap is tiny. You barely notice it. But in low liquidity stocks, that gap can be huge. You might buy at $1, and the moment you try to sell, the best bid is only 90 cents. The price didn't suddenly drop. You just lost money to the gap in the middle. The second problem is volatility. When liquidity is low, prices can jump or drop fast. sometimes for no real reason at all. That makes sensible stop losses hard to use. A penny stock can fall 20 or 30% before it ever moves the way you hoped. And once a stock drops that much, you have to ask yourself a hard question. How confident are you that it will ever get back to where you bought it? Let me show you what this looks like in real life. Take a look at this chart. For a short period of time, the stock takes off. The move looks incredible, and if you were watching this in real time, it would have been hard to ignore. But notice something very important. Each time the price moves up, it drops hard right after. That's thin liquidity at work. Selling doesn't come in gently. The price drops fast and hard. In a situation like this, it's incredibly hard to use a sensible stop loss. Depending on where you bought, you'd likely get hit almost immediately. I know this kind of roller coaster ride can feel exciting, but when beginners go in too aggressively with penny stocks, losses can pile fast. And just to be clear, there was no fraud involved with this company. SNDL is a Nasdaq-listed stock, and no one did anything illegal. This move was driven purely by social media hype, which was able to push the stock around because it didn't have the same level of liquidity as larger companies. At this point, you might be thinking, why is SNDL on Nasdaq, a major exchange? If penny stocks are so risky, why are some allowed to stay listed? SNDL is a good example to explain this. During its 2021 hype run, SNDL was priced in what most people would think of as penny stock territory, since it traded below $5. But it still met Nasdaq's minimum price requirement of $1. And you're right, low-price stocks do exist on major exchanges. But most of the time, they didn't start out as penny stocks. Many were once solid companies whose share prices fell after losses, dilution, or bad news. Others are small or early-stage companies that still meet reporting requirements even though their share price is low. And in many cases, those listings are temporary. Major exchanges have minimum standards, including keeping the share price above a certain level, usually $1. If a stock stays below that level for too long, it gets warned. And if nothing improves, it can be delisted. So when you see a low-price stock on a major exchange, it's often a company fighting hard to stay listed, not one that's comfortably settled there. Penny stocks are risky. They may look small and harmless, but low liquidity gives them a big bite. Prices move easily, spreads widen, and small mistakes turn into big losses faster than most beginners expect. That's why experienced traders pay so much attention to liquidity, and why that one small number, average daily dollar volume, matters far more than the share price itself. My advice is pretty simple. If you're new, it usually makes sense to skip penny stocks while you're still learning the ropes. You don't have to trade them at all. In fact, many of the strong growth companies aren't in the penny stock category. If this video helped, feel free to like it and share it with someone who's thinking about trading. And before you go, there's one mistake that wipes out beginner accounts again and again. I break it down in my next video. Beginner traders make this mistake every single time. See you in the next video.